Welcome everyone to a brand new video. Today we're going to be going over my 80% win rate iFVG inverse fair value gap model. I'm going to be going over some of the tweaks that I've made over trading this model for the last year or so to make it as effective as possible, as consistent as possible, and also a massive issue I faced with it was the discretionary aspect. So we're going to try help you guys to get rid of that as much as possible, and it's as mechanical as possible, but also there's a bit of discretion, and that's what brings a consistency. So yeah, like I said, I've spent around a year refining this system, back testing for years in the past, and making this as perfect and as easy to trade as possible. So today I'm going to walk you through how I trade it and how you can trade it. Just a quick one before I get into this video. Do make sure you go into my Discord and just join my Discord. It's completely free. I'm going to teach the strategy in much more depth in there, and I'm also going to start trading, live trading for free in there on a daily basis. And so you guys can watch, we can interact trading this model. So what is the inverse fair value gap model? So there's a few examples on the screen right now of what an inverse fair value gap is. You've probably heard, if you have anything to do with ICT, you've probably heard. So basically looking for a fair value gap, which is this 3-candle formation, top of this first candle, bottom of the third, to create a bullish fair value gap. That everywhere on the chart are fair value gaps. And that's another thing just to note quickly, if you cannot see many fair value gaps on the chart, then the price action is not very good. Yeah, so there's fair value gaps everywhere on the chart. You can see me just marking them up in the background here. They're literally all over the place. And what I'm looking for with my model is I'm waiting for these fair value gaps to get inversed. So as you can see here, we have the inverse fair value gap. Candle close above is when it's inversed. When we get that candle close above, that's when it's inversed. Again here, candle close above. This one lost, obviously. Candle close below for a bullish fair value gap. Massive trade. And then again here, candle close above. Massive trade. So that's the general basis, but there's obviously a lot of confluences that come with it. You do not just take any random inverse fair value gap. So there's an overview of I'm going to go over an overview of my entry criteria now. I'm not going to go too crazy on the confluences because there's going to be a video coming out later this week about my checklist. So if you're interested in that, you might get early access to that if you join my Discord. I'll probably put it in there before the video comes out. Okay guys, so this is what we're looking for. This is the entry criteria. So first of all, we're looking for a liquidity sweep. So I'd go into a higher time frame to do this. So you've got liquidity there. There's liquidity everywhere, guys. Like here, liquidity sweep. Right, so what we're looking for is the liquidity sweep. So a run on buy or sell stops, and or a fair value gap delivery. A delivery from a fair value gap is when our setup forms coming out of another gap. So as you can see here on the 15-minute chart, we have got this obvious 15-minute gap here. Now, as you can see here, up here, price is delivering out of this gap. So this would be the FVG delivery. This would be the inverse fair value gap. And then let's carry on. So now we're looking for strong momentum. Have we got strong momentum here? Yes, there's no bottom wick. 3 instant candles after entering this fair value gap. There's the momentum. You would enter on candle close, as you can see. Entry on candle close. We target opposing liquidity. So the first target would probably be this liquidity here, because that is the best target for me. It's up to you guys. You guys are going to find your way with this strategy, but what you do need to make sure you're doing is being consistent. So for me, this wouldn't be my first take profit because it's not a 1R. So I'd probably target just inside this fair value gap and take profits there, and then my full TP would be down here. And as for stop loss will be a candle close back above the inversion fair value gap. So what you need to make sure is that you're leaving room. So for example, here I'd be calculating my risk for 40 points, not 30 because that's too tight. Because if you do 30 and then you come and get a candle close all the way up there, your risk is almost double, right? Or if you get a candle close right up here, your risk is double, and that is terrible risk management. What you also need to be doing at the absolute maximum, say if you're going to risk 40 points, you need to have a hard stop loss just around this 40 points. So at this 40 points at this high, be okay, you're going to lose about what, $10, $20 more, maybe 30. But yeah, you need a hard stop loss. You need to drag your stop loss in. That was a massive mistake I made at the start of this, and I didn't blow, but I lost massive amounts on accounts that were going very well at the start of my journey. So don't make that mistake. Place a hard stop. I know the stops are closed below. If you get wicked out, accept it. It's better to get wicked out then get a candle close somewhere in a different universe and get your account blown. So make sure you're doing that. And finally, stop loss to break even. So with the inverse fair value gap model, when we inverse this fair value gap, we are expecting price to come and take out some type of sell side liquidity. That is the logic. So when we come and take out this sell side liquidity, even though it's not a take profit point, because here's our take profit point because it's a 1R and it's inside this fair value gap, this would be our stop loss to break even point. Because if price is truly going to be bearish and come to our take profits, we do not want to see price come down here and then shoot back up. Because trust me, from the back testing I've done, more often than not, it will come down here, tag your break even, and then run up. And that'll be, this here will act as a liquidity sweep in against you. So you move to break even there to protect your capital. More likely than not, you're going to come down here and at least take out this first take profit. Right, hopefully you guys are understanding it. If not, I'm going to show you an example right now of a trade I took this week. So we're going to start off here on the 4-hour chart because this is where my target was. This buy side liquidity here and the entry into this 4-hour fair value gap. That was my target, and that's where I wanted to wait for price to go and see what happens. So we'll come back down on the 15 minute. This was liquidity, massively strong liquidity. We also had another high there as well. So this was a 15-minute high, significant high, and the entry to a 4-hour fair value gap. So there we've got liquidity sweep if we run it, and the fair value gap delivery. So we come down to the 1 minute. As I said, I'm going on the 1 minute. I'm waiting to see how we react from these key levels. As you can see, I've marked out this fair value gap. We got the inverse fair value gap here. So next up, so we've got the liquidity sweep and we've got the obvious fair value gap on the 1 minute to the 5 minute chart. Then we're looking for strong momentum. Is this strong momentum? Yes, we've run into the fair value gap. We've swept liquidity. We've got two massive bearish candles and we've closed straight through the fair value gap as if it's not even there. So there's our momentum. So we enter on the candle close, as you can see. Stop loss is 40 points due to my risk rule. And final target was these equal lows down here. This was the overall target. However, I used the 5 minute to go to break even here, as you can see, when we entered this 5 minutes. You don't want to see price reverse there. And because there was so many fair value gaps in this leg, I actually targeted a 1R here and took, I think I only entered with 3 contracts. I took 2 off at 1R and left 1 to run down to the equal lows. Because there was no solid take profit point, I don't like taking, for example, 0.6R because it's terrible. The average risk to reward, I need to wait for it to at least 0.9R, usually 1R. And then I took my final take profit at these equal lows. Right guys, so I thought this would be a really key part to put into this video. We're going to look at the top 3 mistakes to avoid that I made during my first year trading this strategy. So the first one, not waiting for a liquidity sweep. This is massive because you can have the daily bias wrong, your overall direction for the day wrong, but if you get a liquidity sweep, it's still very likely to be a winning trade because you have actually got some fuel to power the trade and reverse the trade in your direction, especially if you're entering with momentum. So an example of this would be if this trade here, so say we pumped up off open here like we did, but we didn't take this buy side. We got this exact same setup, but here, for example, somewhere here. So we haven't swept liquidity. This is still the drawn liquidity. So you're likely to take this setup and it just runs up and it goes against you. So the next common mistake is taking trades with no momentum. Now look at this. So here, look how much chop we've got through this fair value gap. When we look at these fair value gaps, we're going to see them absolutely destroyed through. We've chopped up, we've chopped up, we've chopped, we've came down, and we finally came through it. And we've left a small gap there as well, a gap in price, which shows the lack of volume in the market. As you can see, this trade didn't reach buy side liquidity, it came back down and failed. So important to use momentum. This is also an example of the third mistake as well. Taking trades with absolutely no context. So, if you look at this, are we delivering from anything here? No. Is there a fair value gap here? No. Would it be better if we came down, so say if this wick here, we came down to there? Yeah, because we'd have been delivering from this fair value gap. But without this there, is there any context to this trade? No, we've not swept liquidity. We're not delivering from a fair value gap. We've just got a random fair value gap in the middle, which is kind of a fourth mistake that we're going to include, just in the middle of this range. So this is the daily range. We're just chopping in the middle of it. It's just not a high probability play. These external liquidity sweeps is what you want to be looking for, not just these random inverse fair value gaps in the middle of nowhere. So guys, that's going to be it for this video. I'm going to put my checklist on screen right now actually, and there's going to be a big video going in depth onto this checklist and how you can use it to be consistently profitable. If you want to grab the checklist, you want early access to it, do join my Discord. Like I said, there's going to be a big video about that coming on later in the week. But yeah, if this has helped you, make sure to like, subscribe. Any questions below or in the Discord. And yeah, subscribe for more videos. I'm going to be going much more in depth on this strategy, and I'm going to try and make trading simple for all of you guys.